even if you curtail supply of money, it really doesn't change the question.
Okay. All right. Cool. We're going live now. Thanks. Thanks. But we'll start with the IMF stuff and then go from there.
So,
Good morning, Smooth 98.1. Love music, love life. I'm Ayo Myro SA. Most welcome to today's edition of Business Express 981. I have Rotis with me. Morning, Rotis.
Morning, Ayos. Good to be in here. Thought it was gonna be another Zoom call due to the stuff ongoing at the and you yeah
Stuff.
you
Name it,
the
Rotis.
protest and
Thank you.
they proved me, although I was there very early yesterday morning, but later on they came out here en masse and they showed up at the polls. Lagos, good morning.
Good morning. All right. We are not alone as well. We have Muiwa Oni from Stanbic IBTC. Good morning, Muiwa. Great to have you. All right, if you'd like to be a part of the show as well, would love for you to contribute. So send your message to WhatsApp 0809 444 You can also tweet at us at Smooth981FM. Use the hashtag Business Express 981.
All right, great stuff. Muiwa, of course, Regional Head Equity Research West Africa for Stanbic IBTC. Muiwa, I want to start off with the IMF's economic outlook, global economic outlook. They've revised Nigeria's their outlook for Nigeria's GDP for 2020. Initially in June, they said we're going to contract by 5.4%. As of yesterday, they revised it and said it's now going to be a contraction of 4.3. Is there anything to be celebrated there, Muiwa?
I suppose from their position, it's saying that the level of contraction won't be as negative. So I guess it's still a positive, thinking that the recession won't be as worse as expected, and if we, because for us going into particularly around the pandemic, we, given the uncertainties, had to set out scenarios, and so had a base case, a worst case, and a bear case scenario. Just more because it was difficult trying to see through the challenges of the pandemic, and so we had a bear case of, I think, over 5% contraction, a base case of 3%, and a a worst case of 5% base case of 4.4%, and bear case of about 3%. So the current forecast seems to be more in line, or just slightly better than our own base case of 4.4% for the year. And so it's still expecting contraction, just given the number of the challenges. So if you think about FX liquidity and how that is having negative impact on trade, look at what the challenges of oil price demand as well, and the constraints from OPEC, and how all that is have a negative impact on the oil sector. And I suppose with the lockdowns, even though we've seen considerable easing in the economy, but with the lockdown, services sector have suffered considerably. You've seen pressure on the manufacturing side as well. And so to your question, it's better. It's showing an improvement, but also still saying that the economy is still going to 2020 is still going to be difficult for the economy.
All right, thank you for that, Muiwa. So what about your expectations for Q3 GDP? Are you, is that going to pretty much confirm that we are indeed in a recession?
Yes. So our expectations is still a contraction in Q3, and I'll say through 2020, still expecting a contraction, and only expecting a slight improvement by 2021. So expecting an increase to 0.6% by 2021, but overall still expecting a contraction expecting a contraction for 2020 still.
Okay. Thank you for that. So okay, you are also looking at a recovery in 2021. Is that still oil driven? like it was in the last recession when we emerged from it in, I guess, 2016, when we emerged out of it in 2017? Or is that, can we hope that it's going to be driven by reforms?
No, so I suppose if you look at the current challenges we have, it's really not just oil. So I suppose there's the oil issue, but there's also the restrictions or the negative impact of the pandemic. And so the recovery is really just expectations of global economy opening up. But I suppose if you consider the challenges already coming up with the second wave and some economies already instituting bringing in some restrictions, I guess there's that risk as well to that recovery. So if you see lockdown similar to the first wave, then suppose that creates a bigger challenge and a downside risk to that expectation. So it's not just oil. So expecting that as economies increase and improve, there will be some recovery in the oil sector, but also just overall recovery in the economy as we see global improvement in global economies as a whole. I suppose the issue of reforms really is not necessarily a short-term fix. It's really more trying to restructure the economy for the longer term. But the reality is that what you can do right now is just more monetary and fiscal easing, really, and not necessarily drive reforms. Because interestingly, the IMF, for example, felt the federal government should be a bit more considerate right now in some of the reforms around tariff or tax increases, for example, given the negative impact of the pandemic on the average Nigerian. So even though our debt service to revenue ratio has been low, the position really was that this is not necessarily the time to be pushing that, just more because of how difficult things have been for the average Nigerian. So even though reforms are critical, but the reality is that you don't see those happen overnight. So if you think about reforms that need to be made around infrastructure and how to attract investments to infrastructure, you don't see that happen over a 6 to 12-month period. It's more longer term as the investment climate becomes more comfortable with putting money to work in Nigeria, and suppose issues around more reflective pricing on petrol and electricity, those would have more negative impact in the short term. That would have negative impact on inflation and cost overall as well.
All right, thank you for that, Muiwa. Okay, so Zainab Ahmed, Minister of Finance, when she was doing a budget breakdown in Abuja, that's for the 2021 budget, she was asked if Nigeria is looking at issuing Euro bonds in 2021 in order to, plug the deficit hole in the budget. And she said, well, she didn't give a straight answer. She just said, well, we'll have to see what conditions are like. Are they worried about the cost of dollar debt? Is that why they're not committing to issuing Euro bonds next year?
So you're saying, I think the last print NTB option print showed rates ranging between 1% and so slightly over 1%. And so if you can borrow short term around 1% in Naira and longer term borrow still in single digits, then can argue that at this point in time you can still stay in local currency and not necessarily look for foreign currency borrowing. So obviously there is the element of the budget that still requires foreign currency, like infrastructure and so on, given the import expectations of that. But overall, as long as you can avoid it, I guess their view is still go for concessionary loans for now, because it'll be cheaper than doing a Euro bond. And just more, I think the primary or the bigger issue is more that given the materially lower local currency rate, it almost makes it's a no-brainer now, because if you look at the push for more foreign currency loans in the past, and having a higher blend of that was really more because of the interest rate or the cost benefits of borrowing in foreign currency, and you don't see that any longer. So this really there was a stronger motivation for that when local currency rates were closer to 20%. You had T-bill rate at closer to 20%, but we don't have that situation right now. It's almost the same to borrow in naira and in dollars. And suppose if you think about the future devaluation impact as well on overall cost of borrowing, it's a no-brainer. That is a no-brainer for now.
All right, thank.
To have naira liabilities and maybe have dollar assets instead.
All right. So one of the tier one banks though, they're looking at issuing a Eurobond. So is it different circumstances for at the corporate level than at the country level?
So not necessarily. I would say it's different circumstances, because if you look at the other commercial banks as well, there's been more. You've seen more borrowings more from DFIs than co. DFIs, some commercial banks, less borrowings from the Eurobond for now. So over time, the likes of GTV, Zenith seem to have exited the Eurobond market, just more because of the options they have with commercial banks and development finance institutions like the CDC and IMF. And so, suppose one can argue that from a pricing point of view, you might still have that flexibility if you're borrowing from foreign commercial banks or from DFIs. And so you still question the rationale for a euro bond right now, just more because of the increased uncertainties you see with in the EM space. And so even though you might argue that overall there's increased liquidity and so there clearly still will be appetite for that, but I would also argue that there seems to be other options as well beyond just beyond doing a Eurobond.
Good stuff. And real quick, I know we only got a couple minutes. I want to get to our messages, but I want to quickly get your thoughts on inflation. In about 2 hours from now, the Bureau of Statistics is going to be releasing headline inflation figures for September. So what do you have? 13.22 now for headline inflation year on year for August. So what do you think will be for how do you see things working out for September?
I think there's still upward pressure, and coming from food inflation, so expectations is that still drives higher this year. And if you think about the reforms around petrol prices as well, and with electricity tariffs, that keeps increasing that upside risk to inflation as a whole. And so we think for our base case scenario, we see inflation averaging around 12.9% year on year, but a bear case of closer to 13.1%. And it seems we're trending closer to that bear case right now. And so if you look at overall year on year average, expectations is that we could get higher to about 13.1%. And I think that's the point, or the frustrations the IMF seem to be having right now, whereby the drivers of inflation seems to be more cost push than demand pull, and I think that was aired by the central bank at the last MPC meeting.
Yeah. All right. Once again, folks, we're speaking with Muyiwa Oni, Regional Head Equity Research for West Africa with Stanbic IBTC. Okay,
real quick. Gwenga Kamo had written earlier on, can the government resolve this NSAS issue? The longer it takes, the more difficult it may become. The economy may suffer more. Also says, so IMF thinks the government shouldn't be increasing tariffs now. I thought removal of subsidies was a signature of the body.
Well, I think it was, taxes. What they want, the subsidies have to go, power and the electricity as well. Okay,
Ugate final comment says, based on the economic climate of the world and the fact that even global powers are postulating that the economic climate won't improve till perhaps 2022. This is a welcome development.
I think he's talking about the IMF revision. How much time we got?
None.
That's it.
Thank
Muyiwa Oni, Regional Equity Research, Regional Head West Africa for Stanbic IBTC. Thank you so much for giving us your thoughts on those stories. Appreciate your time.
All right, thank you. Right, if you'd like to enjoy some great music, stay tuned. And then at 7:30, we bring you freshly pressed 981, detailed analysis of today's national news stories. Good morning.
Beyond the headlines.
We had a substantial amount of capital available to invest.
Business Express
Thank
on
you,
Smooth
thank you,
98.1
Thank you, Mira.
in association with Stanbic IBTC.
Thank you.
Stanbic IBTC.
Bye.
It can be.
Hello, people. This is Frank Donga, and you're listening to Smooth Breakfast.